Today we'll be discussing what is factoring. Factoring is another example of a fund-based financial service. So what is factoring? Suppose you are a businessman and you want to promote your sales. In order to promote your sales, you have to allow credit to your customers. That is, you're allowing your customers to get hold of the goods that they need and make the payment at a later date. So the customers can take the goods and make the payment at a later date. That is known as credit sales. So as a businessman, in order to attract more customers, you will have to allow credit sales. Now, it is a very difficult process to keep track of the customers to whom you sold the goods on credit. You have to maintain proper records of who are the people who owe money to you, and then you have to contact them regularly, you have to remind them, then you have to go and collect the amount from them. So a lot of time is engaged or a lot of time is wasted in this process. So what the businessman will do is he will approach another person known as the factor. He will approach the factor and he will ask the factor to do this activity for him. That is, he will ask the factor to manage his bills receivable or credit sales. So the accounts receivable is managed by a third party known as the factor, who will take up the responsibility of collecting all the dues or all the trade debts of the client. So that is known as factoring. Now let's see the meaning. It is a relationship between the factor and the client. Okay, the factor is the person who will collect the trade dues or the debts of the client or the sales receivables, and the client is the person who makes the credit sales and then sells his accounts receivable to the factor. We can say that the client sells his accounts receivable or bills receivable to a third party known as the factor, because the factor will collect the amount due to the client and hand it over to the client in return for a fees. So factoring is a relationship between the factor and the client in which the factor purchases the client's accounts receivables and pay up to 80% or sometimes 90% of the sum immediately at the time of entering into the agreement. What does that mean? Suppose I am the businessman, I'm approaching another person known as the factor, and I'm asking him to collect all my bills receivables. That is, collect the amount of all the sales that I have made on a credit basis. So I do not have to wait till he collects all the amount to get the amount in my hands. That is, if I have outstanding or if I have got 80,000 rupees, or let it be 1 lakh rupees, I have got 1 lakh credit sales amount. Okay, so I am approaching a factor, I'm handing over all the invoices to him, I'm asking him to collect it for a fee. So what the factor will do is, out of this 1 lakh rupees, 80,000 will be paid to you in advance, or 90,000 amount you will get in cash in your hand, maybe 80 or 90. So you'll be getting cash immediately, and then the factor will follow the process of collecting the amount from the customers who owe money to you. So the factor will collect all the amount, and when he gets the complete amount in his hands, he'll pay off the remaining 10% or 20% to you. Now, from that amount, he will cut a certain amount as his own fees or as his service charge. So that amount will be taken by the factor in return for the service that he provides to you, and you will get the amount. So the biggest benefit of factoring is that you get ready cash immediately. You do not have to wait till the due date to get it from the customer. You can hand over your invoices to the factor and he will make an advance payment, and the remaining payment will be made when the customer makes the payment. So the factor pays the balance sum, that is 20% of the amount, which includes finance cost and operating cost, to the client when the customer pays the obligation. So when the customer pays the obligation after charging a certain rate for the finance cost and the operating cost, that is after charging his fees, the factor will pay off the remaining amount to the client. So, in simple words, factoring is a method of financing whereby a company sells its trade debts at a discount to a financial institution. Here, the financial institution is what we refer to as the factor. Now, there is a company who will sell their trade debts. Trade debts means nothing but their accounts receivable. Instead of making the collection by themselves, they are arranging another party to go and collect their trade debts or their bills receivable or their accounts receivable. And it is a method of financing because once the company approaches the factor will make an advance for the amount and then they will go and collect it from the customer. So it's a method of financing whereby a company sells its trade debts at a discount. This discount means nothing but the amount that the factor charges for collecting the trade debts. So that is the fees of the factor. So it's trade debts at a discount to a financial institution. So let's see before that, let's see what is the definition for factoring. Factoring is a service involving the purchase by a financial organization called a factor of receivables owed to manufacturers and distributors by their customers, with the factor assuming full credit and collection responsibilities. So it is a service provided by an organization who is called a factor, and what they do is that they will collect the receivables which is owed to the manufacturers and distributors by customers, and the factor will be assuming the full credit and collection responsibilities. The responsibility of collecting this amount and to maintain proper records is with the factor. So this is the definition given by Robert W. Johnson. You can go and check other definitions as well. So who are the parties involved in factoring? There are three main parties. There's a client, there's a customer, and there's a factor. The client is the businessman who enters into an agreement with the factor, or the client is the person who sells his bills receivable. So we can say that a client is a businessman who sells the goods on credit. He is making a credit sale to a customer and then he hands over the responsibility of collection of debts to the factor. Instead of taking up the responsibility of going after the customer and reminding him and collecting the amount which is due to him, he will approach a factor and he will hand over the responsibility of collection of debts to the factor for in return for a, and he will make a fee payment to the factor. So the client can save a lot of time if he enters into factoring because the factor will go and collect all the debts. Now the second one is customer, the person who buys the goods on credit. This person will be now making the payment to the factor instead of to the client. So debtor or buyer who owes money to the client for goods purchased on credit is known as a customer. He is the person from whom the factor has to collect the funds. The third party is the factor. He is an agent who collects the dues or bills receivable of his client for a certain fees. In return for a fee, the factor will collect the dues or bills receivable of the client. So there are three parties. There's a client, there's a customer, and there's a factor. Now, what are the services provided by the factor? The factor does not simply engage in collection of debts. The factor will include other activities also. We'll look into that in detail. Before that, let's see the procedure. What is the steps involved in entering into factoring? So first and foremost, there should be a factoring agreement between the factor and the client. So the client has to approach a factor, enter into a factoring agreement. In the factoring agreement, the client will hand over or assign the factor to go and collect his bills receivables or accounts receivables. Now the factor can set a selling limit for the client. That is, he can sell only this much percentage of his sales to a customer on credit, to a customer or different customers. He can sell only up to a certain limit for credit because the factor has a responsibility of collecting all the amount which is due in credit sales. So we can set a limit for the credit sales that the client can make. And they have to enter into a agreement regarding what to do in case of a bad debt. In case a customer does not pay, if there's a default in payment by a customer, then who will bear the risk of bad debts? Who will bear the credit risk? So that should be specified in the agreement. Will the client take up the risk, or will the factor have to bear the risk? That should be mentioned in the agreement. Then what are the situations in which the client will have to bear the risk of credit risk, and what are the situations under which the factor will have to bear the credit risk? This should also be specified. Then what is the fees that is to be paid to the factor for his services? These are the main points that should be shown in your factoring agreement. So the first step is to enter into a factoring agreement. Both the client and the factor will enter into an agreement. Then after getting the approval of the factor, the client will sell goods to the customers on credit and hand over the invoice details to the factor. Now the amount that is due by the customer, or that amount which the customer has to pay to the client, this amount will be collected by the factor. So the factor is assigned the responsibility to go and collect that amount, and at the same time, most of the time, the customer will be given a notification, or the customer will be informed that he'll have to make the payment due to the client to the factor. So whatever amount is due to him, that amount has to be now paid to the factor. This will be informed to the customers. Now the customer will hand over the invoice payment to the factor. Now, at the moment when we enter into a agreement with the factor will pay 80% of the amount in advance to the client, and the remaining 20% will be paid off when he collects the amount from the customer. Now, for the service provided by the factor, he will charge a fees. So what are the other services provided by a factor other than collection of dues or collection of accounts receivables? So the first function is purchase and collection of debts. So I said factoring is a financial service in which the accounts receivables is purchased by a person known as the factor. So the factor will be in charge of collection of the accounts receivable of the businessman. So collection of debts is carried out by the person known as the factor. He will purchase the accounts receivables of the businessman, and then he will collect it. Don't get confused by the term purchase here. It is nothing but the businessman will entrust the duty or the responsibility of collection of debts to a person known as the factor, and in return for this service, the factor will be paid a fees. That is with the first service provided by the factor. Second one is sales ledger management. The factor does not simply go around and collect the funds. He will maintain proper records for each customer. So what is the amount due by the customer? How much amount has been paid till date? So a proper account is maintained up-to-date account is maintained by the factor at all times. So it is easy for the factor to collect the amount which is due to the client. Now the client can collect certain details from the factor. That is, at any time the client can approach the factor and ask what is the balance in the accounts, how much is the overdue period, that is how much the customer has delayed the payment, then what is the amount that is already being collected. He can ask for monthly reports, he can ask for details about each customer. So all this will be prepared professionally and kept by the factor. So factor is a person who manages the sales ledger of the client. Now, credit investigation and undertaking of credit risk. Before a client makes a sale to a customer on credit, the factor will carry out an investigation about the customer's credit worthiness. What is the credit worthiness of the customer? Is he a reliable customer? What was the customer's dealings till now? Has he made prompt payment till date, or has he made any default. If he has made default, then it's better not to allow him credit in the future. So then the client will be notified, do not engage in credit sales with this particular customer. So we'll carry out a proper credit investigation. He will keep a track of all the transactions with that particular customer and check his credit worthiness. Is it reliable to enter into a credit sale with that person or not? And undertaking of credit risk. Credit risk is the risk that has to be faced because of default in payment made by the customer. That is, a customer will agree to pay the amount at a future date, but he will not make that payment at that date. So we have made a credit sales and we are not getting the amount as promised, and then it will lead to a loss. So who will bear that credit risk? Will it be borne by the factor himself, or will the risk be taken up by the client? So in most of the cases, a factor will assume the risk. So sorry, in most of the cases, the client will assume the risk. In certain cases, the factor will agree to bear the credit risk. So bearing the credit risk is another function provided by the factor. Then again, provision of finance against debts. That is, when a client presents the invoices, 80% of the amount is paid upfront, or it is paid in advance or immediately to the client. And then the remaining amount is paid after collecting from the customers. So provision of finance against debts means the client will hand over his trade debts to the factor, and in return for that he will get a advance payment of up to 80% of the amount. Another service provider is rendering consultancy services. Advisory services will be provided by the factor to the client, because the factor will be collecting details about the customers and keeping a proper track record. They will be keeping a contact with the customers, sending them reminders regarding the payment that they have to make. So whatever advice that is required regarding the customers, that will be made by the factor to the client. So these are the other services provided by a factor. They will purchase and collect the debts. They will manage the sales ledger. They will carry out a credit investigation to find out the credit worthiness of the customer and then undertake the credit risk. They provide finance against debts, and they will give advisory or consultancy services to the client. Now, what are the different types of factoring? That is the next topic. I have only discussed a few types of factoring. There are even more different types of factoring, but I have explained only 6 types in my slide. So the first category is recourse and non-recourse factoring. It is also known as with recourse and without recourse factoring. So what is recourse factoring? Recourse factoring is a type of factoring in which the factor does not bear the credit risk. That is, the risk in case of a default payment by the customer will be borne by the client. The factor will not bear the risk of default payment. So in case the debtor does not pay the amount and the amount is outstanding for about 60 to 90 days. Sorry, the spelling is the spelling mistake in the slide. It is 90 days. So suppose there is a customer who is not paid the amount even after 90 days of the due date. They have not paid the amount even after 3 months of after the due date. Then in that case, the client will be notified and the responsibility of follow-up and collection of the debts will be handed over to the client by the factor. The factor will be sending reminders to the customer and trying to collect that amount till that date. But if he still does not make the payment, then that customer will be handed over to the client, and the client will be asked to directly collect that funds from the customer. So in case the customer makes a default and does not make the payment even after that, then the client will have to bear the loss, or he will have to bear the credit risk. So that is known as recourse factoring. The factor will engage in collection of debts. If there is bad debts or if a customer does not pay, then that loss or the risk has to be borne by the client himself. Now there is a situation where if the client asks the factor to uh, collect the overdue debts, then an extra charge has to be paid, which is known as refactoring charges. Second category is non-recourse factoring or without recourse factoring. It is also known as full service factoring. In this type of factoring, the factor will bear the risk in case the customer makes a default in payment. So the risk of bad debts or the credit risk will be borne by the factor himself. So he provides complete service, he provides finance, he administers the sales ledger, he collects the debts at his own risk and renders consultancy service. That is why it is known as full service factoring. The risk of bad debts is borne by the factor himself. So in recourse factoring, the credit risk is borne by the client, and in non-recourse factoring, the credit risk is borne by the factor. Next category is disclosed and undisclosed factoring. Under disclosed factoring, the customers are revealed the name of the factor. The name of the factor will be revealed to the supplier of the goods and the customer as well. The customer will be asked to make the payment to the factor. This is known as disclosed factoring. Under undisclosed factoring, the existence of a factor is not informed to the customer. The factor will be collecting the amounts in the name of the client himself. The name of the factor is not revealed to the customer. So in this form of factoring, the name of the factor is not mentioned in the invoice issued by the manufacturer. In such a case, the factor maintains a sales ledger of the client and the debt is realized in the name of the firm or the client. But the control of the sales ledger rests in the hands of the factor, but he will operate under the name of the client himself. The customer will not be aware of the name of the factor or the existence of the factor. So that is known as undisclosed factoring. Third one is advance and maturity factoring. In advance factoring, the moment that the client enters into an agreement with the factor and produces the invoices, the client will be given a 80% or 90% of the receivable amount due in as ready cash, and the remaining will be paid when the factor goes and collects the funds. Under maturity factoring, the factor does not pay that advance amount. He will make the payment only after collection of the amount from the customer. So in this type of factoring, no advance payment or no finance is provided to the client immediately. He will make the payment only after collection. So this is known as collection factoring. Now, what are the benefits of factoring? See, that is financial service. If you're making a credit sale or if you have trade debts as a businessman, you will have to wait till the due date to collect that amount. But if there is, because of factoring, he does not have to wait till the due date to get the amount. The moment he produces the or gives the invoices to the factor, he will get cash from the factor. 80% of the amount is paid immediately. So you have cash in your hands instead of invoices, and you do not have to wait till the due date to get that amount. And at the due date, the factor will go and collect the amount, but before the due date itself, up to 80% of the amount you will get immediately. So that is one of the main services provided by a factor. So because you have ready cash in your hand, your cash position improves. Because you do not have to wait till the due date, you will get the cash immediately in your hand. You can make your own purchases as on cash basis. And because you're paying ready cash to your suppliers, that is, you need raw materials for your business, and when you're approaching the suppliers for raw materials, you can make the payments in cash itself. And because you are making the payments in cash, then you can avail cash discount facility also. So cash is available to you only because you entered into factoring. You do not have to wait till the due date to get the amount from your debtors. You can get the advance amount from the factor. And with that amount, you can pay off to your creditors or your suppliers. And they will give you some discounts. So you can avail cash discounts because you made prompt payment within the due date. So that is financial services or the benefits of factoring. Second one is collection services. If you engage in the collection service, then you have to maintain the proper records. You have to remind the customers. You have to go and collect the amount. So a lot of precious time is wasted. Now, because of factoring, the factor will do all that, and the client can concentrate on production and material management. Third one is credit risk service. That is, in case of without recourse factoring, the risk of bad debts will be borne by the factor, and in that case, the risk of bad debts need not be borne by the client. So the client is free from such risk also. Now, the next one is sales ledger management. They are professionals. The factors are professionals, so they will maintain records in a professional manner at all times. The details about the customer, the due amount that is due, the details regarding the overdue payments, the monthly sales reports, everything will be available to the factor, and it can be collected from the factor by the client at any time. Next one is consultancy services, advices regarding whether to make a credit sale, the limit up to which they should make a credit sale, which customers to make a credit sale to will be provided by the factor to the client, because they are keeping a proper track record of the customers. Now, there are other trade benefits also, and because there is ready cash available to the client, they can enter into negotiations with their own suppliers for better prices, because they get ready cash in their hand. They can pay off to their suppliers, or the if you are purchasing the raw materials at that time, the supplier will be paid off with cash, and they can ask for cash discounts. That is what is meant by in the first sentence. And they can also offer finer terms to the customers. They can extend the credit period for the customers. Usually, if you are making the collection, then you will not bother to give a long period as credit to the customer, because it will be difficult for you to go around and collect. You'll try to provide only short term credit. But since the factor is collecting the amount, you can afford to give a longer credit period to the customers. This is the benefits that is available to you because you entered into factory. Hope that is clear. Thank you.